Alright, so thanks for watching. Today I'm going to explain briefly the concept of tax loss harvesting to see if maybe this could be a good strategy for you and your family. So the first thing about tax loss harvesting, it only works in taxable accounts, obviously. So your 401k and your IRAs, we're not worried about taxes in those accounts year to year. We're only worried about taxes in those accounts when we take the money out. So here's how it works within a taxable account. Let's say you invest $10,000 into a technology stock. It could be Apple or Microsoft or whatever. So you invest $10,000 and the IRS calls that your cost basis. So the cost basis is important because that's how you track your gains and losses in your account, and then we'll show you how you can use some of those losses in a little bit. So let's say you have $5,000 in unrealized losses, meaning your account value shows your $10,000 of investment in whatever stock is now only worth $5,000. So you go ahead and you sell it before the end of the year. So you bought it at the beginning of the year and you sold it before 12/31 because that's the cutoff for the tax year, and then you'll file your taxes April 15th. So once you sell your stock at a loss, you then realize that loss. So we have $5,000 in realized investment losses at the end of the year, capital losses. So every year, $3,000 of losses in your taxable investment accounts can be used to offset or as an above the line deduction to your taxes. So each year, line 7 of your 1040, you can use up to $3,000 of losses as a tax deduction. And then going forward, you can always carry forward your losses. So if you have a year where you lose a lot and you realize a lot of losses, you could do $3,000 each year into the future as needed or as available. So another way you can use your part of your losses is, let's say you had another part of your portfolio, maybe it was energy, and energy did better this year. Tech was down and energy was up. So you have a $4,000 gain in your energy stock, and then at the end of the year you sell it the same way and you realize your gain. So you have a $5,000 realized loss and a $4,000 realized short-term gain. So what you'll do is you'll take that money and you'll invest it into a different stock. It doesn't matter what stock. If you had Apple, maybe you'll buy Microsoft. If you had Enron, maybe you'll buy Chevron. It doesn't really matter which stock, but it has to be a different stock, and we'll explain more about that later. So your capital losses or your short-term losses can be used to offset your short-term gains in this case. So I'll show you how it works. So if you realize a $4,000 gain and it's short-term, meaning less than a year, say you're taxed at 24%, so you would owe $960 on that gain. So you have your $5,000 in realized losses. We used $3,000 of that as that above the line tax deduction. So we have $2,000 in losses left. So we can use that $2,000 in losses to offset some of our realized gains. And you can see how that would reduce your taxes that you owe on April 15th. So a couple things to remember. The strategy is only going to be effective in your taxable investment accounts, so no 401ks or IRAs. We aren't so worried about taxes year to year in those. We're only worried when we take the money out in retirement. And then, of course, since this can be used as a benefit, it can also be abused. So the IRS makes rules to make sure it's not abused. So the wash sale rule prohibits you from selling an investment for a loss and replacing it with a substantially identical investment 30 days before or after the sale. So the IRS never defines substantially identical, but it should absolutely not be the same security, because then what the IRS will do is they will say you're trying to scam the system, and they will disallow that loss. So there's no penalty or anything, but you won't be able to take advantage of your realized losses in the way we were talking about before. So long-term capital gains go to offset long-term capital losses go to offset long-term capital gains. And then if there's short-term gains left after and there's additional losses, then those long-term losses can go and offset those short-term gains. So they start with like kind, but if there's extra left over, they can offset the other kind of capital gain, long or short. And then this is, even though you're trading stocks in this strategy, it's not an active day trading strategy. It's a long-term tax strategy. So you're not necessarily selling your tech stock because you don't like it. You're selling it because maybe tech didn't do so well this year, but as part of your portfolio, it should be there. And then you're rebuying a similar stock so that you don't get in trouble with the wash sale rules. So we handle this for our clients every day as appropriate. If it's appropriate to harvest some capital losses, we do. We keep track of clients' gains and losses to make sure that they're taking advantage of their carryover $3,000 deduction every year. So if you have more questions about tax loss harvesting, please give me a call and we'd be happy to set up a meeting.